Hello and welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think I'm the most qualified person to run for president. I beat him once, and I will beat him again.
Unfortunately, we're talking about how did Biden do? Did he flub name a couple of names? We're judging him by that. If you hadn't had that debate, you hadn't had that performance, you hadn't had the questions about him, we'd be talking about how deep his understanding is of foreign policy.
The bulk of revenues for most banks is net interest income. It is your interest income minus your interest expense, and that has been under some pressure for banks more recently in recent quarters.
While we've had recession-like readings on consumer sentiment, retail sales, while not really sort of hitting it out of the park, have actually been relatively robust, both on a real and a nominal basis. So we're kind of looking skeptically at consumer sentiment numbers now. We're seeing in a lot of cases consumers are sensitive to price levels, but we know inflation has actually been getting a little bit better over the last few months. So in general, we don't think that this is the bottom falling out for the consumer, and the consumer is actually going to hold up pretty well.
We've got 1 hour to go until the market close. So let's take a look at the major averages here, Josh, because yesterday you asked the question, the rotation that we were seeing yesterday out of big tech into interest rate sensitives, would it last? And the answer is not really, but sort of. So let me explain what I'm saying. So we've got the Dow up right now, almost 450 points, more than 1%, the S&P up 1.2%, and the Nasdaq up 1.4%. So on the big tech side, we have had those stocks that it was just sort of a blip. They're back up again. But the breadth is still there, which is interesting. In other words, the equal weight index and the S&P 500 are neck and neck today. The small caps are also keeping pace. So it's not so much that the rotation is stopped, but maybe one side, it's not a rotation anymore if it's not going around. But in other words, people are buying tech again, but they're still also buying.
Yeah, that was what's so interesting.
All the other stuff.
You could have NVIDIA is working today again, a nice move. But to your point, small caps are also moving higher again. So it's just an interesting. You're right. I mean, you wouldn't call it the rotation, but it's just maybe a sign that this bull market broadening in some way.
That's what everybody's been waiting for, right? So today you've got actually consumer discretionary. That's the best performing group, but it's followed up by tech. But let's also talk about the big earnings story of the day here. I'm just glancing down on my list here to find our big banks, and here they are because we've got them reporting today. JP Morgan, Wells Fargo, as well as Citigroup over here, all reporting all down.
Yeah, I mean, to be fair, if you pull back the chart, and you know this, Julia, like a lot of these names had some nice runs into these prints. Because,
all right, let's take a look at JP Morgan just as an example of that.
Right, I mean, if you pull year to date about 20%, about 40%, I think, over the last 12 months or so. I mean, so plenty of investors have thought, you know what, economy's decent, rate cuts are coming, maybe those restrictive regulatory proposals won't be so restrictive, so they moved in. So you do wonder how much of this also is kind of expectations games playing out as well.
Yeah, most certainly. However, it does seem that the theme that we were talking about initially yesterday with some very different types of companies, namely Pepsi, Conagra, and Delta, about consumer weakness, that is also playing out when it comes to the banks here. And so we are seeing lending activity, we are seeing credit card, charge-offs and things like that. That's something that is getting more attention from some of these banks, even as the capital markets business that includes the markets, that includes some deal-making activity that's starting to perk up again. That did okay for the banks, but it's their sort of bread and butter that is not necessarily doing as well.
Another point, too, sometimes, Julie, you'll hear people talk about big banks as if they're kind of like a bellwether for how the market's going to perform during the rest of the earnings season. Now, Bespoke's Paul Hickey, a true market guru, says that is not true. And we are going to talk to Paul later in the show, find out why that is.
Yes, it should be interesting to see if others are going to follow in this same vein.
All right. For more on what to watch this earnings season, let's welcome in now Eric Friedman. He is the Chief Investment Officer at U.S. Bank Asset Management Group. Eric, it's good to see you. So you heard Julie and I, we were just talking about the big banks. Eric, you saw those earnings report. Just broadly, Eric, I'm interested to get your take on just what you made of those reports and any broader kind of takeaways you think for the market there, Eric.
Yeah, Josh, thanks so much for having us on. And I work for a big bank, so I can't get too much into the specifics, but I'll just say this. I think one of the things that really underscores our bullish thesis is the idea that the consumer is still hanging in there. You did a good job of covering that in the prior segment. That's what we actually heard from these earnings, or that consumers are still, in fact, outspending. Again, there's a difference, there's a divergence across the different cohorts of consumer spending, but in general, you're still seeing real incomes, again, inflation adjusted, still hanging in there. So that says to us that there's still a good backdrop for consumer spending. One of the reasons why we think corporate earnings cycle profits will continue, and certainly keeps us bullish in the near term.
And Eric, what does it look like in terms of that breadth? You know, we've been talking going into this earnings season, not just about breadth of performance, stock performance, but about breadth of earnings performance. And we're very, very early. We've heard not just from the banks, but as I mentioned, a couple of consumer staples stocks. So are we going to get that breadth of earnings growth from other companies?
Yeah, it's a great question, Julie. I think that it's probably early, at least for this quarter, to see it really fanning out. But the great thing about markets is that we anticipate before it happens. At least we try to anticipate before it happens. So part of our thinking, again, we've been actually overweight stocks through equal weight. And that's a long-winded way of saying that we think that large caps is where you want to be. We want to be exposed to those sectors that actually have not performed as well, but also don't have as much refinancing risk as small caps, or have a better profitability projection. So that's been really one of our key theses, has been this idea that equal weight will be a good place to add value. That has played out over the last couple of days, but it's been a pretty slow ride since we put it on in late April. So bottom line is that, you know, for our general thinking, that earnings are still in a decent spot. Consumer spending will probably come in a little bit, but again, on a real basis, you're still seeing incomes that are positive. So I think that if you look at sectors that we really like in terms of areas that are more attractive to us, things like energy, things like consumer discretionary, we still like tech. We would be at very least market weight technology. We think, again, the fundamentals of AI are still there. That's going to continue to broaden out. But there should be, again, a premium placed on companies that don't have as much refinancing risk, that still have decent earnings. That really leads us to that equal weighted position right now.
Eric, I just want to get your take on small caps because they're higher here again. And I'm just curious, Eric, you know, why you think they're higher? Why investors have moved in at this moment? Is it because investors, you know, they've decided, okay, the economy is decent and cuts are on the way, and that's good enough to move into those pint-sized companies?
Yeah, Josh, I think the biggest variable driving small cap right now is because interest rates are coming down. And if you think about the data we got this week, again, your team always does a great job of thinking about and mapping out the week ahead and the week that's just happened. So the consumer price index data yesterday, the producer price index data today, those were both relatively benign. And it actually was a pull forward in rate cut expectations. You have to keep in mind that even though people generally don't think of it this way, that small caps, about 30% of small caps are actually debt financed. And so if you look at what that means is that, hey, these are companies that don't have as diversified revenues as either a mid cap or a large cap stock. And so they're very dependent on a product cycle. They're also very dependent on interest rates coming down to get their cost of capital lower. So what that really means is that as you have a pull forward in expectation for rate cuts, that's more bullish for small caps because of their reliance on debt. Most people think that small caps are mostly equity financed. They're not. There's a lot of debt contingency on small caps. That's why they're doing so well.
Eric, there's been a lot of talk about with interest rates where they are. A lot of people are in cash right now or the equivalent of cash. What is the trigger that might get them back into the market? And is that going to be, you know, sort of an underpinning for stocks for this year?
Yeah, Julie, I think it's an important focal point. It's something that we see a lot with our client base, that clients, again, are almost nostalgic for higher rates in the cash part of their portfolios. The same thing that I think will get things, you know, shifted back into a broader allocation into stocks and bonds and alternatives is just probably the front end coming down. We think it's going to be a very gradual pace. And so I think that as people look to refinance and even think about laddering CDs and things of that nature, which again, we think there's a big opportunity cost in being in cash right now. We would be in other sectors and very happy to talk about those that we like. But I do think it's going to really require the front end to come down. People tend to be pretty hesitant to move out of cash. They tend to be, again, more focused on current yield. And that's something that we think is going to probably change, especially as we start to see that broadening of participation increase, which again, we're positioned for in our portfolios. But that would be the other thing that really gets people to think, hey, it's not just tech, it's not just comm services, it's not just discretionary, but other things are working. It's time for me to come out and get involved. That could be the catalyst that we see draws people away from cash.
Eric, thanks so much. Appreciate it. Have a great weekend.
Yeah, do the same. Thanks for having me.
Thanks. We're just getting started here on market domination. Coming up, AT&T has said that a hacker stole records of calls and texts from nearly all of AT&T Wireless's customers. We'll have more details on that and the fallout when market domination continues. A complicated start to earnings season for the banks. Shares of JP Morgan, Wells Fargo, and Citigroup are all under pressure after their numbers. Wells Fargo's second quarter profit declining from a year ago, while JP Morgan and Citi beat estimates. Concerns over net interest income has been weighing on those stocks. And joining us now, Jason Goldberg, Barclays senior equity analyst. Jason, thanks a lot for being here to help us make sense of what we heard from the banks. I want to mention a comment from the Wells Fargo CFO. because it seems to be specific not just to Wells Fargo, but what we're seeing in the bigger picture. And he said when you really dig into what's happening across different consumers, the folks on the lower end of the wealth or income spectrum are struggling more. How much of a problem is that for the banks now and will continue to be?
It's certainly something to be mindful of when we think about the lower end consumer. They benefited the most from all the stimulus activity we saw coming, out of the pandemic, and that has certainly kind of gone away. And at the same time, you have elevated inflation, so things like food and energy prices are more. And then that cohort tends to rent more and doesn't have the benefit of low yielding fixed rate mortgages locked in from a couple of years ago. So there is some pressure there. As it relates to the banks, it's just not a huge contributor to revenues. While the big banks tend to big in credit card, which is an area to be mindful of, they tend to focus more on the higher FICO customer base. So it's certainly something that weighs a little bit on overall results, but I think not something that overly concerns us in here.
Jason, let's stick with Citi. CEO Jane Fraser, of course, pursuing a big turnaround there. You're on the sidelines, though, Jason. Equal weight. How come?
Listen, it just takes a long time to turn a big ship, and that's a very big ship. And I think you got the news, earlier in the week that they had didn't fully resolve one of their consent orders way back from 2020 and under kind of increased scrutiny from the OCC now. And, listen, there's going to be some bumps in the road. So they've made a lot of progress, particularly under Jane's leadership, just more work to do. And it'll take some time, for them to get even back to a low teens ROTCE. I think they're targeting 2026, where earlier today you had names like a JP Morgan put up a 20% plus ROTCE already.
So when you look across the banks, both who we've heard from thus far and who is yet to report, who do you think is best positioned right now, and what seems like sort of a muddling along environment in some ways?
Yeah, if you look at kind of the trends that we've seen, today, we saw particularly strong trading and investment banking results. So early next week, we heard from Goldman Sachs and Morgan Stanley, and we think they'll benefit from those trends. On the flip side, loan growth continues to be subdued while you're seeing upward pressure for both, non-performing assets and loan losses, which kind of the regional banks are overexposed to. So those are kind of, I think, the themes that we'll be paying particular attention to as more and more banks report over the next couple of weeks.
And Jason, one name that stands out today, Wells Fargo. I know you like that name. It is under pressure in today's trade. Jason, it looks like net interest income for Q2 missed. Analysts talking also here about higher expense guidance. But what did you see in the report, Jason?
Yeah, no, I think you kind of captured it. Net interest income was a bit lighter than anticipated. Loan growth has been soft to start to the year, expected to kind of remain soft near term. They also priced up some of the wealth management deposits, which also adversely impacted results. And then on the expense side, I think a couple of that was really related to some one-time-ish type items, as well as just better than expected fee income. And there's some compensation and other revenue-related expenses tied to that, which weighed. But, the stock had a strong run last year, continued to be up, double digits, into the print. And you're seeing given some of that back today. But I think overall, there's still a ton of opportunities with the name to reduce expenses. And if you think about this net interest income trajectory, after about a 7% drop in the first half of this year relative to the second half of last year, that should slow closer to 2% in the back half of this year, and then trough as we head into 2025. And then we would look for them to benefit when the Fed ultimately does lower rates, which reduce their funding costs and historically has accelerated loan growth.
All three of the banks also saw an increase in the investment banking business. Deal activity picking up a little bit, the capital markets doing pretty well. Is that something that you think is going to continue here?
Certainly on the trading front, you've seen, you saw year-over-year increases both from JP Morgan and Citigroup as they're just benefiting from increased activity in both the equity and fixed income markets. Volatility is more elevated, volumes are higher, and you're benefiting that with something, if you just think of, think of the recent election activity and just the surprises we've seen across, various countries over the last month or so. And this just drives increased activity in things like currencies and interest rates and equities across the globe. So I think the banks are benefiting from that. And at the same time, you're just seeing a pickup in IPO activity. Debt issuance has been active. And ultimately, we think you'll see an increase in M&A activity as just, industries continue to evolve and grow.
Jason, good to see you. Thanks for joining us.
Always pleasure.
Let's get to some trending tickers now on Yahoo Finance. Besides the banks, first up, we got to talk about AT&T and Snowflake. Shares are lower today following the telecommunication giant, that is AT&T's, disclosure of a significant cybersecurity breach. And in a press release issued today, AT&T said hackers had accessed and copied customer call logs from Snowflake's cloud platform between April 14th and April 25th, 2024. One interesting tidbit, more of a minor note from this, but that I thought was interesting, Josh, is that, of course, there is new regulation around how quickly companies have to report these. So it happened back in April. AT&T didn't disclose it publicly because the FBI told them not to. They wanted to look into this further. So there are some exceptions to that sort of public disclosure of these types of hacks.
Yeah, I see the FCC telling media, Julie, the agency has an ongoing investigation. It's coordinating with our law enforcement partners, and this is being described as one of the biggest breaches of private communications data in recent memory. It was interesting because I was reading through the reports, and the data does not include the contents of the calls and messages, so personal information, social security numbers, birth dates, but the records do apparently identify the telephone numbers.
And the location. I think there's location data that is included in this too, so you can sort of extrapolate where
the
callers and receivers were.
Right.
So all of this is interesting. CNN quoting the chief information security officer at Snowflake as saying that they didn't find any evidence that was caused by a vulnerability in Snowflake's platform, but Snowflake is still down. Separately, it looks like that Piper Sandler cut its price target on Snowflake to 165 from 240, but they talked about rising macro risk factors and elevated budget battles. So it's unclear to me if it has anything to do with what's going on at AT&T.
All right, we'll keep watching. Our next trending ticker, Deckers, the footwear brand, approving a 6-for-1 stock split and also approving an increase in the number of shares of common stock and preferred stock to accommodate the stock split. Split is going to happen after market close on September 6th, with the new shares being released after market close on September 16th. So that was the issue. That was the headline here. The board approves a 6-for-1 forward stock split, put it before the shareholders at the September 9th annual meeting. We'll see what they have to say about it.
Yeah, this is the owner of Hoka and Uggs. Hoka's in particular have been very popular and they've been on a run. Speaking of runs, the stock has been on a run. It's up over 60% over the past year. I took a little walk down memory lane for this one. It went public all the way back in 1993 at $15 a share, and you can see the shares are almost at $900 today. This is not the first time they've split the shares either. They did a 3-for-1 split back in 2010. So second ever split for Deckers.
We've talked about splits a lot recently. MicroStrategy just this week.
Yes.
All kinds.
I know. It's been ticking up a little bit.
All right. Coming up, it's the latest edition of our series Goodbye or Goodbye. Stay tuned. Much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're looking at real estate investment trusts as commercial concerns have made some investors hesitant. I'm here with FM Investments Chief Executive Officer Alex Morris. Good to see you, Alex. Thanks for coming in.
Thanks for having me back.
So obviously, this is a group that has really been weighed on by interest rates by and large, although there's a lot of other stuff going on in real estate. But it's pretty differentiated among the different subsectors within it. So let's get to it here. The stock that you like here is called Stag Industrial. The share's not much changed over the past year. We've seen a little bit of an increase. So let's get to why you like it here. So it's an industrial REIT, but you said within industrial, it's sort of well diversified. So what does that mean to you?
So when we think about REITs in general, they do all sorts of stuff. They own homes, they own, as we're talking about self-storage. This is industrial centers. These are things that collect rents. This is business at work, right? Most people don't own their factory. They end up renting it from somebody else. They have a pretty wide portfolio, and over the last 6, 8, 10 years, management's been on a tear of actually trying to do a good job at that. And they've done that. Same-store sales are up, and they found a way to be very conservative in how they acquire to make sure they're acquiring accretive properties, and they've really succeeded there. And that's mean an intelligent diversification. They don't own just one sector. They're in 41 states. They're well diversified across industries. They're ready for various different parts of the economic cycle.
And when you talk about owning factories as well, or the factory facilities at least, there is, of course, this big push for onshoring, for nearshoring in the United States.
Absolutely. So as jobs come back, right, every big political election coming up, politicians can talk about bringing jobs to America. They're well positioned for that. Supply chain issues from the pandemic, some fixed, some not, some realizing they need to be onshore, not elsewhere, or closer to us. They own all of those facilities, and they own them generally in tier 1 markets, where we think a lot of that action will happen. So if that plays out, and we think it will, they're going to be in the right spot.
Interesting. Okay. And then also, there's this focus on sustainable earnings growth. And you alluded to that a little bit when you talked about their sort of rational acquisition strategy as well, that, they're sort of not focused on surges, but rather kind of a more steady.
This is the traditional good management story, right? It's boring to be a good manager. You have to do the boring things from time to time. You can't just shoot the lights out, but they've done that. And they've really focused on finding the right properties in the right markets, acquiring at the right rates, saying no to deals that don't make a lot of sense. It's not going to just keep growing because it looks like the growth's there. Management's demanded to know that they will be continued growth over the next 5, 6, 10 years. Stag 10 years ago was a different business. It was the type we said, well, it's going to be a turnaround story. Let's wait and see. We think that moment is now. Interesting.
Okay, and then let's talk about what maybe could be something that could be a risk here, and that's economic weakness among customers.
Absolutely. I mean, risk for every stock is that customers dry up, base dries up, but in particular when you collect rents and you're relying on higher same-store sales, which they've enjoyed for a long time, if that reverses, all of the thesis we just had starts to fall apart pretty quickly and maybe in a compounded way. It just seems unlikely given all of the break points that they've put in, as well as the sort of fire breaks they have in their business model.
And just quickly as well, I want to just allude to rates here as a factor, not just for this company, but for REITs generally, right?
Absolutely.
We've been seeing, for example, yesterday, some investors come back into REITs as we saw rates come down a little bit. What do you expect there to continue to happen?
Well, you and I are usually talking about T-bill rates and whatnot, and those are going to come down. We still think there's one cut this year, but it won't actually make its way into the REIT market and into the actual economy of folks getting loans until that rate cut actually happens. Mm-hmm. So whether it's 2 starting in September or 1 in December, it's really a 2025 story before that really makes it in. But the stock market is really good at guessing where are we going to be in that market. So now is the time to start putting your bets on and building a position, because you're not going to do it all in one day.
Gotcha. All right, let's talk about the stock, though, that you think folks should avoid within this sector, or more sort of the subgroup, I guess,
exactly,
within REITs. This one sort of representative of that. We're talking about CubeSmart in this case, but we're talking about self-storage more broadly here. And you say there's too much of it.
There is, and their stats prove it out. They're 90% occupancy rate, which sounds like a lot. They're used to 100% and being oversubscribed and building new facilities every month. Build rates are down, vacancy rates are up, and as a result, rents are way down 16% year over year, which in the self-storage space, this is a short-term rent industry. If you're not building as much, you can't push them out, and you're earning less per space. That's not a good growth story at all.
Yeah, it doesn't sound like it. As you mentioned, effective rates are down here. Are they slowing down building as a result of all of this?
They are. I mean, wisely so, but a big chunk of that industry is this is a first derivative play on the housing market. Most folks don't go out and buy storage just because they want to hold stuff they can't see or use. They need to move from one place to another, and they need somewhere to put their stuff for a short while. Less people moving means less need for storage. Less need for storage means fewer people move, and it sort of compounds on itself.
Gotcha. And then also the future, what does that look like? Because one would think at some point we're going to see an improvement in the housing market that might spur things on. But what does this look like to you?
Well, so we do think that will come back. Rates will help a little bit there, maybe, maybe not. But people are less mobile now than they were before because you're locked into a pretty good interest rate on a mortgage in most cases. So we think although this was a great ride, now is the time to take a pause because we have a hard time seeing exactly where the growth comes from. It may, but we just don't see that linear path. So time to put our money somewhere else.
Okay, gotcha. Well, when we talk about the risks to the downside for Stag, let's talk about the risks to the upside, that there's excess capacity that leaves quicker than expected, or if interest rates come down more quickly.
Yeah, if interest rates come down faster, people move more, or now they just have more money to buy more stuff and they need to put their old stuff somewhere, this obviously wouldn't work out. Our theory is, though, there's so much excess capacity in that space today, other competitors they have who have done the same thing and overbuilt, that you're going to have a lot of lag between that and the stock really taking back off. You'd be able to pick that up in the numbers in a quarter or two and get back in. We just don't see that right now.
All right, fair enough, Alex. Thanks a lot. And do you have any position in either of these guys?
So as the firm, we're buying into Stag, and we've done so with proceeds from our Cube position that we're now exiting.
Okay, gotcha. Thanks so much.
Thank you.
Good to see you. And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes next week at 3:30 p.m. Eastern.
All right, let's get to some calls of the day now. UBS downgrading Tesla from neutral to sell. The note saying it's increasingly difficult to justify valuation. For more, we're bringing in Yahoo Finance's Praz Subramanian. And Praz, here was one money line in the note here. While Tesla is investing heavily in AI and the tech is making progress, they say, investment is costly, pace of improvement may slow, and the payoff is long dated. Dramatic.
Pretty much, yeah, that's pretty much it. No, so downgraded to sell here. Though he did raise, Joe Spack at UBS did raise his price target to 197 because they were well low where Tesla's trading at right now. But basically the call is here, you mentioned valuation. The way that they did is kind of some of the parts evaluation here is the auto business was worth X, and then there are other activities like energy and robotics and FSD were worth Y. But in this sense, they're in their analysis, that other activity stuff was kind of overvalued by the market by a lot, by about over 60% or so, according to their analysis. So he thinks that there's some possible room to come down because of the fact that these other activities have high risk, long-term horizons. It's unknown whether they'll actually pay off. So this is the concern for Joseph Spack and UBS right now.
I mean, the funny thing is the stock isn't down today. It actually is. I mean, initially, I think in pre-market trading when this note came out, it took a little bit of a hit. And since then, it's turned higher along with the rest of the market.
Right, all the EV stocks, all sentiment-based sort of trading here today and on Friday.
Yeah, definitely. Well, and speaking of EV-based stocks, right, we got another call that's related to that. EVgo is this one. Benchmark, in this case, is raising its price target on the company, which is an electric vehicle charging network, from $3 to $5. That's where they are now. And the firm's reiterating a buy on the stock. Josh always knows when you see a small company like this take a huge gain. I also look at the short interest, which is pretty high on EVgo, but nonetheless, still a little more bullishness around the network.
Yeah, I mean, these EV charging stocks they're a hard trade these days because of the fact that high capital intensive business, you don't have the sort of amount of EV charging users out there that you'd like to use. This is a bet for the future, and I think with this note, Benchmark saying that by 2027 they see that EBITDA positive sort of payoff there, and down the line here. But they note that one, they've seen higher utilization for the chargers for EVgo. EVgo's footprint is in very high DC charging usage locations, so they're in the right spots. They have the right utilization, but like I said, to create a DC fast charger, it's a couple $100,000 per charger. It's not cheap at all. So you need a lot of users to defray that cost, and that bet is still a long-term bet. We saw this quarter in Q2, only 8% market share for EVs of all vehicles sold in the U.S. So there's still a long way to go. It's a bet for the future. I think they like the financials. They like the sort of presence of where EVgo is, and I've used EVgo a few times, and they do have a decent amount of fast chargers.
Yeah, the analyst he highlights some risks that he tells his clients to think about before piling in, and adoption rates, government regulations, and more specifically with this name, low stock price, low float, cash needs, but that's obviously not his base case. He's a fan.
Right. I was going to ask you also, Pross, as somebody who's used this stuff, remind me, when you charge, do you join it as a member and then you get a certain amount of charging? Do you pay like you do for gas, where you just pay for whatever charge you get?
I mean, so you pay as you go. You can do that, and that's what's painful about that is you have to download the app, put your information inside.
Yeah.
Then you have to actually find the charger, and they have different weird names, and you got to find the charger. I'm using the Rory, the charger Rory, right? I'll have some weird name, and they got to add it, hit it, set it up, plug it in, wait for it to actually start charging, and then it goes, and it's
And
just
you have
not
to have an app
seamless.
for each charging network.
Exactly.
Right. So you got an EVgo one and you got a Tesla one or whatever else.
Well, Tesla, you don't need anything. You just plug the thing into the car because it's
But
attached.
you have to find it still, I guess, through the Tesla app.
Yeah. But once you go there, you just take the nozzle out and stick it into your car, and it's all linked to your car. There's
If you have a Tesla?
If you have a Tesla.
If you don't have a Tesla, you still have to do all the other stuff.
Yeah, but then with Ford, with the new Ford's joining the NICS, that's going to soon allow that to be
I feel
seamless.
like we need an updated guide on how to do all this stuff from you. I'm giving you your next assignment, Pross.
Okay, all right. Maybe you should come with me.
Oh, there we go. All right, I'm giving myself an
Let's all
assignment.
go. Let's all go.
We've given ourselves
Let's
an
all go on the
assignment.
road.
I'm good. You guys go. You guys go. Report back.
Thanks,
It's okay.
Pross. All right, let's get to our next mover as well, based on a call. It's Barclays raising its price target on Royal Caribbean from 165 to 185. That note citing plenty of potential upside for the cruise line and for the industry more broadly. They also raised earnings estimates for Norwegian cruise lines. But I think what stood out to me was the sort of last part of the note here on cruises, or where Brant Montour, the analyst, said, how is cruise demand continuing to outperform broader consumer, including restaurants and other experiences?
How so, Julie?
The simple answer is price. And that's what we've heard from the cruise lines themselves, right? They've said, we offer value to people. That's what we try to offer.
Versus land-based travel, particularly, they'll always have.
Right, and so I guess that's what, people are buying that.
Yeah, likes this name. By the way, he also told clients he expects the company to announce a capital return program before the year's out, potentially even earlier. Cliffhanger there. Rates them an overweight, target 185. Not as enthusiastic, it doesn't look like, Julie, by the way, on rival Norwegian. There he's equal weight. But on
but he
RCL,
did raise the estimates, though.
On RCL, he likes the look of it.
Yeah.
Meanwhile, moving on, Goldman Sachs releasing a new report about its top 25 tactical trades for earnings season. The note stating that 2024 is going to be known as the year of the stock picker. We have one of the authors behind that report joining us right now, John Marshall, head of derivatives research. John, it's good to see you. Maybe just start actually big picture question I have for you, John, because I know you're tracking options, options positioning. As we head into kind of the thick of earnings season, John, I was just curious if you've noticed, have there been any kind of big changes, new changes, John, that you would call out in terms of just trends and themes?
Yeah, thank you very much for having me. I'd say there's two really big themes that are happening right now. The first is extremely low correlation between stocks. Correlation, people talk about the Mag 7 and how much they've dislocated from the other 493 stocks in the S&P 500. But when you look at all 500 and you calculate the correlation, it's been only 1/3 the level of normal. And this is near an all-time low. And options markets are telling us that we're going to remain in this low correlation environment for the rest of the year. What the disparity that's causing is we've got a VIX that's at 12, which is at an extremely low level, and we've got earnings day moves for single stocks of 4.8%, which is at a 14-year high. So it's a very uncorrelated market that we're in, and that's why we're so focused on picking stocks.
Because the bottom line is it really pays off to be right in this market when you're surrounding earnings. So what you guys went and did, you looked at your most out of consensus calls from your big team there of sell-side analysts, and you picked some interesting ones. Chipotle's on your list, Starbucks, Enphase Energy on the list, Bank of New York Mellon, which reported today, Affirm. So it's a pretty diverse list here. Microsoft's on the list as well. How do you go about figuring out which are the most out of consensus calls, and then what's the best way for people to play these guys?
Yeah, it's a great question, and it's something that we've honed for years. We've published this list in exactly the same format for the last 12 years, each quarter, talking with our analysts. analyzing their estimates relative to consensus. And what we found with all of our studies is that analysts have a powerful amount of information in their estimates. And when our analysts are significantly above consensus or out of consensus, the stocks tend to rise on average. And when they're below consensus, they tend to fall. And so we're very focused on that sort of trend as we are doing this analysis. We start out with 1,000 stocks under coverage. We whittle it down with quantitative methods to get it down to about 500. And then even further to get to this list of 25 by speaking with our analysts and understanding the drivers behind their views.
You know, as we were just showing there, John, I mean, that's a lot of different names, sectors, industries. Any kind of broader underlining threads that are connecting these?
It's a great question. Our approach is very idiosyncratic. We're looking for where analysts identify things that are special about the stock that are going to drive an unexpected move in earnings. However, I would say underlying many of the calls is this tug of war between prices and inflation. Inflation has driven up expenses for many companies, and prices are just now starting to come up. Allstate is a great example. The cost of repairing a vehicle or replacing property that people have insured has been rising, and they're just now able to catch up on the rates that they're able to charge their customers for auto and home throughout the country. And that is what our analyst is picking up as an idiosyncratic opportunity. We're seeing similar things for Chipotle and for Starbucks, where we think that the growth can return.
John, there's also another measure that you guys have been watching that I want to dig into a little bit. This one's a little wonky, so I'm going to ask our viewers patience for a moment. You guys are looking at single stock options as a measure of positioning. That is here, I believe, in the purple line. The blue line as well is a high retail sentiment basket. So where are retail traders excited about right now? That's what that line shows. And basically what we're seeing now is that the retail sentiment has diverged. It's higher than those single stock activity. So what is this telling us looking at this chart, and how can people use it going into this earnings season?
It's a great question. And this is the number one chart that we focus on as we approach earnings season. Single stock options have become a very valuable indicator because they tell you about the enthusiasm level of retail and hedge funds. So most single stocks are, when people trade single stock options, they are buying 1 to 2 week call options. And so the volume in single stock options is really telling you about this enthusiasm level. And when that enthusiasm level wanes, the stocks don't drop immediately, but the stocks see pressure after that. We saw this heading into last earnings season from March 8th to early in April. We saw a decline in these option volumes. And then sure enough, in the first week of earnings, we saw a pullback of about 4% in the S&P. Now, it's not our call that the S&P is necessarily going to decline here, but weak stocks with weak fundamentals, stocks that have high leverage, we think hedge funds are going to be more emboldened to short those stocks as we're entering earnings season because there's less of that threat of a short squeeze from retail in the options market.
And John, you mentioned you all have published your support for a long time, years now, John. So I'm just curious, what's its track record in terms of just performance?
Yeah, so we tend to look at this just as a gut check relative to the S&P, and a couple percent above the S&P annualized is what we've been running at. That's just how the math works based on our published ideas.
All right, thanks so much, John Marshall. Good to see you. Really interesting stuff for people to chew on going into earnings. Appreciate it. Coming up, healthcare could be headed for growth, a growth turnaround this earnings season. We're going to take a closer look at how to play it in your portfolio next on Market Domination.
Are you curious about what's happening in the ever-evolving media landscape? Whether that's breaking down the Paramount merger, what's going on with Netflix's pricing, learning the latest ways streamers are making money online, or you want to figure out what's the next best media investment opportunity. The media space is no longer as separated or as siloed as we once thought. Traditional media giants are adopting streaming practices, while streaming networks are implementing appointment viewing strategies. And YouTube, the wild card, may be beating them all. Join us for Yahoo Finance's Media, Streaming, and Investing. What's next? We'll break down the latest acquisitions and mergers, the state of the streaming wars, and tell you the stocks you should keep an eye on.
The healthcare sector could be headed for a turnaround. The ETF that tracks the S&P 500 healthcare sector today touching an intraday record. That's its first since February. I guess the turnaround's already in place. After several consecutive quarters of earnings declines, our next guest expects a return to growth this quarter. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. And joining us now is Dan I, Fort Pitt Capital Group Chief Investment Officer. Indeed, it looks like these stocks are anticipating some return to growth here, Dan. So what's driving that?
Yeah, well, I think we are really at an inflection point. You know, it hasn't just been a few quarters. We've had actually 6 consecutive quarters of earnings declines from the healthcare sector, really as these companies normalize after the dramatic pull forward from COVID. So we think we're at an inflection point. Analysts are expecting very strong earnings growth for this quarter. And the picture should even improve in the coming quarters and into 2025. And the sector trades at a very reasonable valuation, a pretty significant discount to the overall S&P 500 as well.
Another big theme here, Dan, in this sector, of course, has been M&A. And I'm just curious if you expect that trend to continue, and if so, Dan, would there be any acquisition targets, possible ones, on your radar?
I do expect it to continue, especially in the pharma space, where we have these companies that generate a tremendous amount of free cash flow, and most of those are looking to bolster their pipeline through both organic R&D and also through inorganic acquisitions as well. But we tend to focus on some of the cleaner stories in the space, and some of the companies that really have the cash position to actually do the acquisitions.
There's also, of course, the demographic trends that are maybe supportive of healthcare broadly here. So when you try to pick stocks within healthcare, do you try and look at those that are trying to benefit from those demographic trends specifically?
We do, and I think those demographics are extremely favorable for the healthcare sector. If we look back about 10 years ago, we had about 14% of the population above age 65. Today, that's above 21%. If we look at healthcare spending, 50 years ago, that was 5% of GDP. Today, it's closer to 17% and rising. So we think that just creates a very strong fundamental backdrop for a lot of pharmaceutical companies as well as healthcare insurance.
And Dan, let's get into some names as well. Merck, for example, I think you noted is your top pick in the pharmaceutical space. How come?
Well, Merck just has a very solid top-line revenue growth profile. They've grown revenue at about 7% a year over the last 5 years. Looks really attractive compared to their peers, and we think that they can do it going forward. A lot of that growth has really come from their blockbuster cancer drug, Keytruda, and they're currently working on an injectable version of that drug, which could extend patent protection well into the 2030s. The company also has a really strong pipeline of drugs that they'll be bringing to the market over the next 3 to 5 years. And a lot of players in the pharma space just can't say that. Company that generates a lot of free cash flow, which gives them a lot of flexibility and optionality to do some of the things like I talked about, look at M&A opportunities, raise the dividend, and increase their buybacks.
One of the things that Merck isn't necessarily exposed to is the GLP-1 trend right now. Or at least they don't have anything out at the moment. And I'm wondering why, if that was sort of a conscious move on your part not to pick one that is leveraged to that, or what you're thinking around that whole theme is.
Well, I would say it's certainly something that Merck is looking at. And, I think if we were to see an acquisition, maybe that's one of their targets. But I think when you look at valuation, much different picture with Merck that only trades about 13 times next year's earnings estimate. So there's not the amount of froth or over optimism, I would say, with some of the ones that are more exposed to the GL1 space, which is certainly becoming more competitive.
And Dan, another thing I want to get your take on, United Health. Stock has not done much this year. It's actually down about 3%, but earnings on deck. They report next week. What do you expect to hear, Dan?
Yeah, I think the real focus for UNH this quarter is going to be on the medical loss ratio. That's really what's put a hamper on the stock. They're having to pay out a higher percentage of their insurance premiums in medical costs. We think that that's really a hangover from the COVID environment where everybody delayed medical visits and procedures. But over the long term, this is a company that's grown their earnings per share in mid to high teens. That's right in line with their medium-term guidance going forward. We think that's very doable, and we're really looking at the name as a growth company that's trading at a value multiple. Stock only trades at about 16 times, and if they are growing earnings, in the mid-teens, that's a very attractive setup in our view.
I'm wondering there were recently reports that the FTC was looking into suing the pharmacy benefit managers. Is that a risk that you're looking at in this sector at this point? Are you trying to avoid some exposure to that?
Well, I think we just realize in general that healthcare stocks tend to be the punching bag sometimes in the political season, and it's just it seems like it's very popular for the politicians to point the finger at PBMs. But when you dig into the business, I mean, these are extremely low margin businesses. It's all driven by volume. So I think the more that you really dig in, I don't think it's very easy to say that they're out there gouging the consumers.
Dan, great to have you on the show today. Thanks so much for joining us.
Thank you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action on the closing bell. Stay tuned for market domination overtime.
There's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's see where the major averages ended the day. We had a little late day coming down off the highs for the major averages, but the Dow still finishing higher by almost 250 points. or 0.6%. The S&P up 0.5%, so cutting some of its gains, but still higher on the day. The Nasdaq up by 0.6% here. And as we've been discussing, the rotation that we saw yesterday has not reversed itself today, but we're still seeing pretty broad-based gains. The S&P equal weight, for example, today outperforming the S&P 500, and small caps still continue to beat the broader market. Again, Jared, we're going to continue to watch to see if that continues.
Yes, Julie, I think it's going to be fascinating to track if what we've seen, this reversal, this market rotation over the last day, if that continues into the next week and maybe beyond. So let's load the Wi-Fi Interactive behind me. I'm going to leave this on the Russell 2000 for a second. Just want to show you for the week, up 6.19%. Most of that was Thursday. Huge outperformance there. And there's more we can dig into. I'm going to be doing a deep dive with Josh in about 30 minutes there. But here's a sector action for today. Consumer discretionary, after a drubbing yesterday, well, a lot of the mega cap sectors took big hits yesterday. It is in the number one position today, up 1.3%. Communication services, the only sector in the red here. Also note that materials and tech, XLB and XLK, also up about 8 to 9 basis points. And if we take a look at the Nasdaq 100, much prettier picture than yesterday, although we are still seeing some red and dark red. Meta, you'll notice at the bottom, is down about almost 3%, while Nvidia is back up 1.5%, Apple up over 1%, Microsoft, Amazon, Alphabet, just under by less than 0.5% each of those names. And if we take a look at some of the leaders here, we can see for the day, solar was a big outperformer, followed by disruptive small tech. That's the ARC fund that you're looking at there, ARC Innovation Fund, and then home builders. After yesterday, and this has to do with the decreasing interest rates, especially on the longer end, we saw a big jump in home builders. That has continued today, and just kind of more of the same there. I'm going to leave us with a picture of ARC. This is ARC components today. You can see Tesla there is a big elephant in the room, but if we sort by equal weight, we can see a lot of the smaller names that have been decimated over the last few years, like Roblox. Remember that pandemic darling? Well, that is now outperforming. Josh.
Thank you, Jared. U.S. stocks rebound a day after the Magnificent Seven saw their worst day in nearly a year. The S&P 500 retaking that 5,600 level and notching a winning week. Investors assessing big bank earnings and clinging on to rate cut hopes. For a closer look at the market rotation, joining us now is Bespoke Investment Group co-founder Paul Hickey. Paul, it is good to see you. So this market continues to be interesting here, Paul. I'm just looking, NVIDIA finishes the day higher, Paul, tax on about 1.5%, but small caps finish higher again, Paul. So what are we to make of this, Paul, as investors?
So I think interesting is the understatement of the week to call what's going on. It's been just a fascinating week. Back on Tuesday, you saw these big moves in Apple had come. Tesla had a 11-day winning streak, I think, and Apple was, or this was as of Wednesday, and Apple was up 7 record highs in a row. And it seemed like the Mag 7 band was back together again, but just when they got back all within close to new highs, you got a day like Thursday. And I think what part of this was we highlighted this earlier in the week. The S&P 500 equal weight index had underperformed the S&P 500 over the last 6 months by one of the widest margins on record. There were only 10 or 11 days going back to 1990 where the spread in performance between the cap weighted and equal weighted was wider, and those were all from December 99 to March of 2000. So you can only get the rubber band stretched so much before it either snaps or it just comes back. And I think this is what we've seen this week. We're seeing a reversion to the mean, and these short-term moves are just as historic in the other direction as the longer-term outperformance of the cap weighted was. Yesterday, we saw these, the S&P 500 underperformed the Russell 2000 by the 4th most in a single day on record. So we're seeing these big moves, and it's hard for investors to navigate them, but it's something to look for, and
Right.
We think longer term, that you're better served in some of the smaller names within the S&P 500 or within the market overall in small caps.
Now, to go with your rubber band analogy some more, Paul, and it's good to see you. You know, it gets stressed, it comes back, or does it like sort of do like a boinging effect? In other words, are we then set for some volatility, not just in the overall major averages, but in the components as we see this sort of positioning play out?
Well, yeah, when you throw a big rock in the water, you tend to see more waves going forward. But that's what's the craziest thing about what we've seen this week is the VIX is 13. If you look at periods when you've seen this type of performance divergences between large and small caps in a single day, or the S&P 500 market cap versus the equal weight, the VIX was over 20 in all those occurrences, and sometimes as high as 70. So you just look at the days I was just mentioning before when the S&P underperformed the Russell 2000 by similar amounts or more than yesterday. It was you were looking at the 87 crash, you were looking at the COVID lows, and you were looking at October 2008. You wouldn't compare any of those three periods to what we're seeing now because the market's still near highs. So, sometimes you want to have an answer to everything, but this is just one of those things where it's just the last couple of days just don't have really any parallels to what we've seen in the past.
Well, I want to expand on the VIX in particular a little bit, because your recent research on the VIX in election years also caught my eye, because the VIX is low like for any year. It's particularly low for an election year. And as you said, it's puzzling that it's low while all of this is also going on in the market in terms of this re-rotation. So what gives? What are your possible theories for why that's happening?
There's the options market has changed a lot over the years, so that could have some impact on what we're seeing here. I think there's other people that would have much better answers than me. So besides that, I wouldn't get too far into it. But what I would say is, between now and the end of the year, expect to see volatility move higher. We're in a low volatility environment right now, so you have factors, you have the election coming up, obviously, and you just have a seasonally weak time of year coming up. So that's something to look at going forward here. We wouldn't expect these placid times to remain like that, and we would expect more volatility, because when you see moves like we've seen in the last couple of days that are so counter trend to what we've seen, people are going to be off sides, and it's just going to cause markets to become a little bit shakier as people reposition.
Paul, big banks reported this morning, investors, not so thrilled. Sometimes, you could hear investors, they look at the big banks, Paul, and they say, well, it's kind of a bellwether for how the market's going to perform during the earnings season. You look at the data, though, and you say, maybe not so fast.
Yeah, so you have to go back just to last earnings season. If you look at what happened on that first Friday when all the major banks reported, the stocks went down sharply. They had pretty weak reactions to their earnings, and people were thinking like, oh, could be problematic for the upcoming earnings season. But then what we saw was in earnings season, the S&P 500 was up 2%, including the weakness on that day. So I wouldn't read too much into that. And encouragingly for earnings season, what we've seen is, there's earnings are expected to grow, and there's optimism on earnings growth. But what we track coming into earnings season is what are analysts doing in terms of the estimates on the companies they cover in the weeks leading up to earnings season. And what we've seen is that there's been more downward revisions to earnings estimates in the last month than there's been upward revisions to earnings estimates. And that's the case for every sector except technology, where an equal number of companies have seen upward and downward revisions. And what you tend to see when you see more downward revisions than upward revisions is the bar gets set low, and the market performs considerably better during those earnings season when estimates have been getting cut than when they've been rising. So that's something to look forward to and be encouraged about during this earnings season. And that's applicable to the broad market and not just a handful of names.
All right, we'll see if that plays out. Paul, thank you so much. Nobody better at looking at market history for this kind of stuff, so really appreciate your guidance.
All right, have a great one.
Thanks.
Thanks.
President Biden trying to direct attention to his economic record in last night's news conference.
Many economists thought my initial initiatives that I put forward, can't do that, it's going to cause inflation, things are going to skyrocket, the debt's going to go up. What are you hearing now from mainstream economists? 16 economic Nobel laureates said I've done a hell of a job. That under my plans so far and what's going to happen in the future if I'm reelected, that things are going to get much better.
However, concerns over his age and ability to serve a second term are lingering, especially after the president made a blunder earlier in that same news conference, referring to Vice President Kamala Harris as Vice President Trump. For more on the road ahead for Biden in the 2024 election cycle, we've got Yahoo Finance's Rick Newman. Now, Rick, yes, the blunders overshadowed things, but I don't know, Joe Biden's always made those types of blunders. Those are classic Joe Biden blunders.
Yeah.
You know, where he misspeaks a name,
yeah,
for example.
he's been doing that since the 1980s when he was probably in his 40s or 50s. Right. But when you do it consistently, you're 81 years old, and it comes after, it's not just the blunders. It's the terrible performance he put on during the June 27 debate. He is still doing damage control from that. And as much as he wants people to listen to what he says about the economy, I think there's nobody who watched that press conference yesterday and their number 1, 2, or 3 takeaway was, oh, the Biden economy is doing pretty well. I mean, it was all about how, the rest of this campaign is going to be, can Biden finish his sentence?
What does he do, Rick? I mean, if you're the Biden campaign, to the possible, the entire story, to your point right now, this election, is this guy up to the job, mentally, physically, which has been the story since that debate.
And it is completely blotting out what is a good economic story for Biden. I mean, things are finally going his way. We got the inflation news this week. I mean, if the rate of inflation is probably going to be below 3% on election day. And I think just as important, polls are showing Americans are less concerned about inflation. They don't think inflation is going to be a problem. It's like it doesn't matter for Biden because because this age issue is just blotting out the sun. What does he do about it? If he stays in the race, I think that he has to be out there constantly in front of people at live events, on the news, doing these unscripted things, because reading from the teleprompter at campaign rallies is not going to do it, because nobody, the networks don't cover that, and nobody sees it. He has to prove in the most visible ways possible, he has to get on primetime TV live and prove that he's capable. Now, I don't think Joe Biden is senile or anything like senile. I've been watching the way he handles questions. He stumbles over, he struggles to get the words out sometimes. But on the other hand, when he talked, he spent about 10 minutes in the press conference yesterday explaining what the United States and its Western allies need to do about this new, very troublesome alliance between Russia, Iran, China, and North Korea. And he was very lucid, and I thought he explained it as well as anybody I've heard in the last 4 years. So, I mean, that's not simple stuff. And he had command of the facts, but this is not what wins elections.
Right.
Expertise, is like that. The ability to write it down if you have time is not win election. I mean, your TV personality totally matters. It has since 1960. So Biden has to, I think he has to just be in front of people constantly and showing that he's alive, he's vigorous, he has a sense of humor, he has some self-awareness about his own age, try to turn it to your advantage.
Well, and to your point, it's I think I was seeing someone on Twitter comment on this, that it's not a question of dementia. There's no question of dementia here. It's a question of vigor and energy and sort of being up to the task in that sense. It's not that he doesn't know what, know his stuff. He knows his stuff.
He knows where he is.
Right. And he knows.
Is that our standard?
No, I think it's a little bit. I mean, he knows he has, as you said, a significant, policy expertise. As he demonstrated, and he did it in this press conference to a degree. So I guess your argument is, just like Jay Powell says, we need more good data. we need more good Joe Biden if he's going to, if he wants to make the argument.
And the obvious, so we need to see more of him improving it. But the obvious risk for him is he comes out and he trips over himself every single time, and he says, twice within the space of 2 hours yesterday, he completely destroyed people's names. He did it on camera twice. He called Zelensky Putin before he was in that press conference.
He did make a joke about it. He caught himself.
He did. He did not catch himself the second time. So that's the risk. I mean, I would say at this point, by the way, there's still even odds or better that he's not the nominee.
Can I ask you, as you're gauging that, who are you watching? I mean, are you watching the donors, congressional leadership, former Speaker Pelosi? I mean, you saw her on Morning Joe. I mean, who do you want? Maybe you watch all those.
Right, and the heavy hitters the heavy hitters I would consider to be Obama, Chuck Schumer, the Senate Majority Leader, Nancy Pelosi, the former House Speaker, and Hakeem Jeffries, the current House Minority Leader, the leading Democrat in the House. None of them has yet said you have to go. Pelosi has opened the door and said, I want to know what Joe's decision is.
Well, she said it's up to Joe.
Yeah, but he's already made, basically saying, Joe, think harder. Go back inside, close the door, and think it over again, and come back and tell us what you decided.
Yeah, right.
I don't, but I think it's going to happen internally before it happens externally. So that's the way it should happen if he goes. Now, Biden kind of hinted in that press conference yesterday, if his advisors tell him he can't win against Trump, then he would withdraw. So he was basically saying, the advisors, you got to tell me I can't win, and I'm taking him at his word here.
But the latest polls have been decent for him, no?
It's really surprising.
Yeah.
There are polls, one out today from NPR, showing Biden's a little bit ahead of Trump. I guess, remember, Trump has all of these problems about Biden. Trump has all of these problems and more.
Not to extend it, but those same polls are so tough to read, Rick, because the NPR poll, you're right, but then they say almost the internals, almost 2/3 of Americans think Biden doesn't have the mental fitness to serve as president. It's just so contradictory. It's hard to get a line on.
Well, they like the other guy less, I suppose.
And nearly 6 in 10 believe Trump will win. I mean, you're just trying to read these polls.
I think voters are contradicting themselves.
Yeah.
Is what's going on.
Well, maybe polls are the problem? I don't know. All right, Rick.
No, the candidates are the problem.
We could do this forever. Everything's the problem. All right, except for Rick Newman. Thank you so much. All right, still to come, we're going to speak to Zillow's chief economist about the latest housing hurdles. Stay tuned. More Market Domination Overtime on the other side. Home buyers might finally be getting some good news. Mortgage rates declining in the last week, falling to their lowest level since late June. And fresh data from Zillow shows that nearly a quarter of all listings got a price target cut last month. Joining us now is Orphy Divounguy, Zillow senior economist. Orphy, good to see you here. So we're hearing, and you're hearing through your data, that people are cutting their list prices of their homes. But that doesn't mean that the prices are going down significantly across the board here. So what are we to make of this?
Yes, look, affordability remains the biggest challenge in the housing market today. But as a result, right, buyers pulling back a little bit, you're seeing competition is slowing down and inventory is building up. Our data, Zillow data, shows that total for sale inventory is now up 23% when compared to a year ago. Of course, that's going to put some downward pressure on house prices.
And Orphy, I'm looking at the 30-year fixed here per Mortgage News Daily. We're at 6.82%, Orphy. I'm curious, when you all look at the data, crunch the numbers, 6 months out, 12 months out, where do you think that is, Orphy?
Well, look, it's good news, especially since the labor market is still where it's at, right? We have a low 4.1% unemployment rate. The loosening in the labor market came from a big increase in labor supply, as opposed to layoffs. And so potential home buyers are basically seeing mortgage rates easing, and that could be helpful for the housing market going forward. You take that and you combine that with the fact that we have more inventory than we had a year ago, and those are positive signs ahead.
We keep hearing about all these positive signs, Orphy, but on the flip side, there's a chart from Morgan Stanley that really struck me when we spoke to somebody from there yesterday, and it has to do with the average mortgage of someone who is in their home right now versus the current mortgage. And you can see on the right side of your screen the big gap, obviously, and you're well aware of this, right? But again, it just illustrates the cost of moving is high right now for people who have mortgages that they got more than a couple of years ago. So isn't going to take quite a long time for that to change?
Look, yeah, I'm very familiar with that chart. Rate lock is kind of loosening a bit. We saw this year so far, new listings, the number of homes coming on the market, fresh homes coming on the for sale market, actually increased. They increased up until last month. We had a drop of about 9% this month, but that's basically normal. The housing market is seasonal. If the drop that we saw in new listings this month is similar to what we would have seen in 2019 or 2018, you're right. So we have more and more people coming on the housing market. Those people are basically, either getting married, having kids, needing more space. So homeowners are coming back. Of course, they've returned to that kind of pre-pandemic seasonal pattern. And so for the rest of the year, we're expecting new listings to decline as we head into the slow season. But with more inventory, right, than we had a year ago, I expect 2025 to be an even better year than we've had in the last couple of years.
Orphy, let's say I was looking to move. I could go anywhere in the country I want. I want an area that was relatively more affordable, had more inventory, more diverse kinds of inventory. Any areas of the country that would come to mind?
I would go to Texas. I would go to Austin. I would go to Houston. Those are markets where, when you look at, let me throw an interesting stat. We did some Zillow research shows that basically the down payment needed to keep your monthly cost affordable for a median income household is about $128,000 across the country. On average. You go to markets like San Francisco, and that's close to $900,000. You go to an Austin, and you can still put down roughly 20% or even lower in order to keep your monthly cost affordable. In San Antonio, that number is just $92,000. And so you go to markets that build a lot of housing, and you have more inventory. In fact, in Austin, we now have more inventory than we had before the pandemic. It's the most housing inventory, increase in housing inventory compared to pre-pandemic times in the country. So there's a lot more options. Buyers have a lot more bargaining power. And at least that's what our Zillow Market Heat Index suggests. that basically buyers, even though sellers have more bargaining power across the country, in places like Austin, in Texas and Florida, you have the pendulum is swinging in favor of buyers.
All right, Austin, more inventory, great barbecue. I don't know what else you could ask for, Orphy. Thank you so much. Appreciate it.
Pleasure to be on.
Time now for what to watch next week. Starting off on the earnings front. Earnings season is in full swing now. We're going to be getting a new batch of bank earnings throughout the week. Morgan Stanley, Bank of America, Goldman Sachs, all on deck. It's coming after mixed results from big banks Friday. JP Morgan, Wells Fargo, and Citigroup all did close lower on the day.
Outside of the banking sector, United Health Group, Netflix, and United Airlines are reporting earnings next week. Netflix, one of the big ticket reports, and it'll be announcing results for the second quarter on Thursday. Analysts expect big numbers from strong engagement and subscription growth.
And moving over to the economy, monthly retail sales coming out on Tuesday. The economists forecasting sales to decline 0.2% for June. We're also going to get some housing data with housing starts and building permits on Wednesday. Housing starts expected to tick up slightly to 1.3 million, and building permits holding steady at 1.39.
And finally, if you're low on stamps, it might be time to stock up. The price of U.S. postage stamps is rising from 68 cents to 73 cents on Sunday. The price hike coming as the U.S. Postal Service reported last November that first-class mail fell to the lowest volume since 1968. Wow. You gotta love those forever stamps in your back pocket?
Do I have any?
Yeah.
Not currently, no.
Do you send any mail?
I
don't send a lot of mail either. I guess that's the problem. All right, that'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. We've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. It's a winning week for the major indices. The S&P 500 shaking off yesterday's losses and closing above that 5,600 level. Thursday, a sell-off was sparked by rotation out of big tech that's continued to boost names in other sectors, and that broadening lifting the Dow today to close above 40,000 for the first time since May. And staying put, President Biden dismissing calls to lead the presidential race in the news conference that showed off his experience, but also his age. More Democratic lawmakers have come forward demanding Biden step down as reports circulate that party heavyweights are also pushing the president to end his re-election bid. Plus, it's been nearly 8 months since the last of the Hollywood strikes came to an end, but studios and the box office still feeling the effects. We're checking in on the state of the summer blockbusters. That's coming up. President Biden saying European allies are urging him to continue re-election efforts.
I'm not having any of my European allies come up to me and say, Joe, don't run. What I hear them say is, you've got to win. You can't let this guy come forward. It'd be a disaster.
The ongoing uncertainty surrounding the November ballot and who will be in the White House come January could have major geopolitical consequences, according to our next guest. I'm joined now by IXIC Stone-Fish, Strategy Risk founder and CEO. IXIC, good to see you.
Thanks for having me.
So what you were arguing, IXIC, is interesting, is that come the election in November, to the extent that after that election we have some degree of confusion, uncertainty, it's too close to call. A candidate says he won, he didn't. That could actually open the door, in your opinion, to maybe bad actors making moves.
We are in unprecedented times, and it's now possible, or arguably even likely, that the election is contested. Biden wins, Trump says he wins. It's a dream for autocrats the world over, and especially for China, to make a move against what the United States' global interests are.
And what would China's move be there?
A lot of different possibilities. The scariest is that China goes and seizes Taiwan, which is a democratic nation that Beijing has long claimed as part of China.
What would you actually, though, I mean, Isaac, what odds would you put on that, China invading Taiwan? Are you 50-50, lower, higher?
In the next 6 months, I would put it at maybe 10 or 20%, but it would be such a catastrophic event that it would reshape global markets, and it's something that everyone has to plan for. It's higher than we think. Longer period of time.
Why do you say it higher than we think? Because I'm surprised you even go that high.
Because Beijing has been very clear for decades, and they now have the capability to do so. And the biggest reason why they wouldn't, as far as we can tell, is that the United States would step in and would defend Taiwan. And then that would almost certainly be World War III, which is a major, major decision for any polity to make. But if the United States is distracted, or even worse, seems like it's leaderless, it could be a very good time for Beijing to act.
So those are different variables to consider. And if they were to invade China, IXIC, what would that actually look like? I mean, is it a limited strike? Is it something bigger, broader, larger?
There's two different scenarios. There's a limited invasion, which Beijing hopes then is all they need to do, because Taiwan cowers, the United States doesn't act, Japan doesn't act, or it could be a full-fledged invasion. So we have the Russian model where in 2014 they seized Crimea, they started going in the east of Ukraine, and then full-fledged invasion 8 years later. Beijing could do that, or they could just start day one with a massive attack. It's very difficult to know. It's very opaque at the top of the Communist Party, but because there's so much we don't know, we have to plan for this uncertainty.
Let's say they did launch an attack, and I realize these are hypotheticals, Isaac, we're just trying to game out the scenarios. What do you think a U.S. response would be?
It so depends on who's in the White House. It depends on what timing. It depends on what the polling is like. It depends on who controls Congress. So Congress has the power to go to war, but US presidents for the last several decades have ignored that or overlooked that. And so I think, frankly, a strong Biden presidency, if that's even still possible, is more likely to go and defend Taiwan over China than a Trump presidency.
Why do you say that, Isaac?
Because Trump is more able to be talked out of these things, and he's less of an establishment leader. The establishment on both the Democratic and Republican side, in Congress and in the executive branch, is more pro-Taiwan than Trump is. Trump is an outlier there, even though he's been very critical of China. But we're all rewriting the playbook over the last couple
And what would
weeks.
be the argument, Isaac? I mean, if you're trying to make the case that Taiwan is in America's national security interest, what would that case be?
There's the economic case, but the most important case is that if Taiwan falls to China, it's hard to say America is the most powerful country in the world. And countries around the world will no longer be able to look to the United States as the global provider of security.
In other words, you said there would be ramifications, is your point, both for allies and adversaries.
And for the United States itself. So there's massive security
Meaning how they
risks.
view us in some sense.
Exactly, that's a big piece of it. And so if you don't think America can or should be the world's most powerful country, fine, you can let Taiwan fall to Beijing. But there's massive amounts of implications there for what that would mean. It's a big problem for Japan, which is fairly close to Taiwan and Okinawa and the other home islands. And it really just sends a signal that the United States is retreating inward.
Big, important topic. Isaac, thanks so much for trying to help us walk through it. Appreciate it.
Thanks for having me.
All right, moving on. Stocks bouncing back from Thursday's tech-driven sell-off. The Dow closing at its highest level since May and just above that 40,000 level. Here with more on the trading day takeaways, we have Yahoo Finance's very own Jared Blickery. Jared.
That's right. We are looking at a breadth explosion right now, and that is my first takeaway. We really saw things come alive yesterday, and that was in reaction to that weaker than expected CPI print carried over into this morning. And I was looking at the new highs of all New York Stock Exchange listed stocks, and there are about 3,000 in that group, but the new highs were about 300 today, 306. That was the most since March of this year, and it just shows you the general strength that just kind of erupted in this market over the last couple days. We hadn't seen that. We've been talking about concentration. Well, here we got the opposite of that.
It's happening. The kind of skeptical take on the market has been, this market has bad breath. But now we see this explosion, Jared. Is it just? Listen, we've obviously been tracking small caps very closely, but where else are we seeing that? What other vertical sectors?
Yeah, you're right. It's not just small caps. We saw the Dow come alive. It hit an intraday record. Didn't make the close, but it hit an intraday record. So it is at the highest level that it's ever been. You see the small caps coming alive, but it's not just limited to some of these fringe sectors or the cap sectors. You can look at XLV, that's healthcare, just had its first record high since February. I mentioned the Dow. Financials also first record intraday high since May 17th. And then you look inside financials to regional banks. KRE has exploded here.
That's interesting.
Arguably, that's a mid cap. But so you see all this strength coming from different parts of the market. So I find that encouraging with a couple caveats.
All right, hit me with the second bullet point, Jared.
We got Wall Street all in on a soft landing, looking for those rate cuts. And in fact, more rate cuts have been priced in over the last day, and that's in response to that CPI figure and the PPI figure. In fact, we're seeing about 10 to 15 basis points of more rate cuts than we were 2 days ago. So here's the federal funds rate. This is the Fed's benchmark rate. This is when we talk about the Fed adjusting rates. This is the rate. And this goes all the way back to the beginning of the century. And you can see here, this was a global financial crisis. Rates came up to 5%, and then they got lowered pretty drastically all the way down into the 2009. And then again, they got ratcheted up here into the pandemic. And we actually started lowering rates before the pandemic, and then we got that steep drop when it was obvious what was happening. But you'll notice here, look, this is where we are. This is supposed to be July, actually. This is December of this year. This is December of next year. This is a much more gradual slope here.
So you're saying a soft landing is done. It's a done deal. Is this your point?
Yeah, I'm afraid that we got to look at history here. I know this is only two other prior events, but if you look at the slope, and let me just erase these lines, you look at how steep this is and how steep this is. What happens when everybody's expecting a soft landing, and that's usually the base case, nobody sees the hard landing. Nobody sees the recession data until it's right in your face. Usually, all of a sudden, the labor market falls out from under you, and there's a rug pull, so to speak. And so that's what we saw. The pandemic, okay, you want to say that's an outlier? Well, we saw that in global financial crisis. We saw that in the year 2000 in the dot-com bubble bust. When things get bad, they tend to go down very quickly overnight. And so the onus now that we know where we are in the business cycle, the data has to come in either pretty good or not too bad. If it comes in really, really bad, you're going to see expectations for a lot more rate cuts, and it's not going to be pretty.
All right. Third bullet, Jared.
Let us go for a yentervention. This is kind of under the radar here. It looks like yesterday when we did get that market-moving CPI report, the Japanese government was in the market. And I'm going to go to our US dollar versus the yen. Here you can see over the last 2 days, This was a big drop. This is the dollar getting weaker on that CPI announcement. And it looks like the Bank of Japan was also feeding into that. So they were actually buying yen, they were selling dollars during that same period. And then later on that night, when they reopened for business, I think it's about 8 p.m. our time, this is UTC down there, by the way, they sold again. They sold the dollar. And then this morning, I'm not sure, we don't have evidence yet if there was a yen intervention this morning, but it's possible. We see the movements there. And so the Bank of Japan, the lesson is they don't want a weaker yen, and they're going to get in the market to achieve their ends. And if you're on the opposite side of that trade, if you're in the carry trade, you're going to get stomped on.
Let's say you're an investor right now. Yeah. You're listening to Jared Blickery do the charts. You're going into the weekend and you're wondering, why does this matter to me? What do you say to that, Jared?
Look at this chart. Well, how could this not
first,
matter?
I mean, it's a beautiful chart.
Oh, thank you.
Yeah.
I think it matters because at the end of the day, we got to remember that when the proverbial stuff hits the fan, and it might be hitting the fan in Japan pretty soon, the governments, they will change the rules and they will do what's necessary to protect their markets. In this case, it's going to be the Japanese currency and their government bond market. I lived through the flash crash. It's indelibly imprinted in my brain. When one part of the market breaks in a big way, it spreads everywhere very instantaneously.
There it is.
Yeah.
Killed it. Thank you,
bet.
Jared. Coming up, making a hard switch here. The box office taking a big hit in the second quarter, but could sequels and superheroes come to the rescue? More Ask Me for a Trend on the other side. Movie theaters are in the thick of summer blockbuster season, but the lingering effects of 2023 actors and writer strikes, plus the lack of a Barbenheimer-type event, means the box office is still lagging. For more on the state of theaters, joining us now is Chad Beynon, Macquarie Senior Analyst, Gaming, Lodging, and Leisure. Chad, it's good to see you. So let's dig right in to the U.S. box office, Chad, because you've been crunching the numbers on Q2. What did you find, Chad? It sounds broadly soft.
Sure. Thanks for having me, Josh. Yeah. April and May started off very soft. So as a quarter, we're looking at 40% lower than the second quarter of 2019. And that's mainly because of April and May. We were still seeing kind of the end of a lack of product from the strikes. June fared much better, right? We had Inside Out, we had Despicable Me. So there was a glimmer of hope, similar to what we saw last year at times. You see a Barbenheimer. Right now we're seeing the Inside Out, Despicable Me. It feels like something, exciting is happening again. But then you go through a month where people just decide to not go. But yeah, Q2, we're definitely going to see the negative operating leverage for these companies. They're not going to generate that much EBITDA. And then we're kind of looking for Q3, Q4, very strong Q4. And that's when we're lapping the comp of very low production given the strikes in Q4 23.
So easy comps, Chad, but also in the back half of the year, is there just going to be some movies, some content that's coming that you're banking on as well?
Yeah, look, summer is generally a pretty busy time. I think the summer overall should be good. It's not going to be great, but I think it's good. The next one in the next couple of weeks will be Deadpool and Wolverine, which could do over 400 million of box office here in the U.S. In that release. In the fourth quarter, that's when you see Gladiator 2, you get Wicked, Moana 2, Lion King, just a lot broader content. So I think the Thanksgiving through Christmas period will be very strong. Generally in the fourth quarter, September, it is a slower month and that kind of carries into October. But yeah, it's a back half weighted story. We have seen the stocks pick up, I'd say year to date, right? You've seen Cinemark recover here. It is part of this small cap movement, IMAX as well. And then obviously AMC on the meme kind of roaring kitty movement as well. But yeah, we are hopeful that Q4 picks up. And then for next year, 25, I do think we're going to see some nice growth year over year as well.
Let's get to some stock picks too, Chad. IMAX, I believe, is that your top pick, I think? How come? What's the argument there?
Yeah, look, within this category, IMAX is the top pick. They're a little bit of a different story. To be honest, this is a company that has asked for coverage, probably from more tech analysts versus the traditional movie theater consumer analysts. But this is a company with a really strong global brand. They have a strong backlog of projectors that'll be rolled out over the next 3 years. That brings about 10% growth per annum. So if you think about that growth like you would for a franchisee, a Marriott, a Hilton, that's pretty strong, and that drives earnings. And then in terms of the product, they obviously have the Hollywood product that they lean on, but what they've done over the past couple of years is have more local language product in India, in China, in some of the Latin American markets. So the global box office for them, is more predictable. It's a little bit more steady. They obviously benefited from, the Taylor Swift movement last year. So I think it's a better business model, good margins. They're not the ones running the theaters. They're kind of taking, half of the business that comes through. So I like that more predictable model. We're at a $24 price target. It is a small cap one that we really like here.
Chad, great to see you on the show. Thanks for joining us and have a great weekend.
Thanks, you as well.
And coming up, it's our chart of the day. More asking for a trend on the other side.
Are you curious about what's happening in the ever-evolving media landscape? Whether that's breaking down the Paramount merger, what's going on with Netflix's pricing, learning the latest ways streamers are making money online, or you want to figure out what's the next best media investment opportunity? The media space is no longer as separated or as siloed as we once thought. Traditional media giants are adopting streaming practices, while streaming networks are implementing appointment viewing strategies. And YouTube, the wild card, may be beating them all. Join us for Yahoo Finance Finance's media, streaming, and investing. What's next? We'll break down the latest acquisitions and mergers, the state of the streaming wars, and tell you the stocks you should keep an eye on.
Retail investor activity has declined, and it's likely emboldening short sellers. That's according to a new report by Goldman Sachs. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, we earlier talked to Goldman Sachs derivatives research head John Marshall, who helped outline what exactly this means. This is something that Goldman Sachs does measure on a regular basis, and it's not that unusual of a move going into earnings season, but really the thrust of the report was that investors need to be careful about which stocks they are betting on going into earnings, because we've been seeing some outsized movements in them last earnings season, and they expect to see that this earnings season again. So here what we're looking at is single stock options volume. And this goes back really a couple of years here, and we've been seeing a little bit of a decline as of late in that activity. Now, at the same time that that's been happening, Goldman Sachs also has an index of retail sentiment, and that has been sort of going sideways to even ticking up as the single stock options go down. John Marshall said that that indeed could indicate that hedge funds might have an opportunity to step in here with some shorting activity. Here's what he told us earlier.
Now, it's not our call that the S&P is necessarily going to decline here, but weak stocks with weak fundamentals, stocks that have high leverage, we think hedge funds are going to be more emboldened to short those stocks as we're entering earnings season, because there's less of that threat of a short squeeze from retail in the options market.
And that's evidenced by that decline in that single stock option activity, that less threat of a short squeeze, as we have a retail sentiment that is relatively strong right now, at least according to this particular measure, Josh.
All right, thank you, Julie. And that is a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.